Well, good afternoon. Mark Milam, your mortgage professional here. Happy Friday, Friday the 13th. Could not be a more apropos date. Winding up the week in the mortgage-backed securities market. Boy, we have seen a wild ride this week. As a matter of fact, this week has undone all of the improvements we've gotten since January, and those improvements have been substantial, as I'm sure you know. Over the past 30 days or so, we have seen record mortgage applications. We have seen record low mortgage interest rates. And then this week happened. And we saw a tremendous amount of volatility and a sell-off in mortgage-backed securities. And when mortgage-backed securities sell off, interest rates go higher. And not only did they do that this week, they did so sharply. So I'm going to flip the screen around here and walk you through what happened, and then we're going to talk about why it happened and what you can expect next. So here's what happened this week. This is this week's activity, and these red days are bad days. These are mortgage-backed securities selling off and interest rates moving higher. And you can see for the prior several weeks, we were in much better territory. We were just inching our way towards these record low for interest rates. Now, if we zoom out a little bit more to a 3-month look back, you can see we have not been at these levels since back on January the 2nd. Okay, so we're going all the way back to January 2nd. We've undone all of the improvements received since January the 2nd, and that's where things stand as of this afternoon. Why is this happening, right? Why is this happening? The stock market is taking a tumble. Typically, all that money would flow from stocks into bonds. Why aren't mortgages doing better? Why aren't mortgage-backed securities doing better? Well, a couple of reasons. The first reason is the volatility that has hit the stock market, the uncertainty that has hit the stock market has also hit the bond market and the mortgage-backed securities market. Just because there are stocks and bonds competing for the same investment dollar doesn't mean that the dollar has to go one place or the other. There are plenty of people who are pulling their money and holding it in cash. Just look to Warren Buffett, certainly a voice worth listening to there. That's one reason. It's just the simple volatility of the market. Traders are trying to find where the new normal is, and we really haven't established it yet. But a more interesting facet is we're almost the creators of our own monster. Record numbers of mortgage applications have been submitted over the past 30 to 45 days. We have shattered prior Mortgage Bankers Association records, and we're seeing all of that volume start to move through the pipeline. Well, when the volume is either hitting the street or about to hit the street, these mortgages are bundled as mortgage-backed securities and they are sold. Well, anytime you have an excess supply of anything that you're trying to sell, the price for it starts to go down, right? There's no one's going to pay top dollar for your mortgage-backed securities when there are billions upon billions to be sold. So that's one of the problems we've got. We've got this enormous amount of supply that is hitting the market for traders to sell, and the price for it is simply too high. So as that price comes down, as those red days tick down, interest rates start to go up, and that's exactly what we are seeing. So a lot of factors at play here, a very complex time in the mortgage industry. One thing I would encourage you is that if you get a quote on a mortgage rate, double check that quote because it could have changed intraday. We are seeing intraday pricing freezes with new rate sheets published. That's very common. Matter of fact, we had 4 of them yesterday, which is a record in my career. In my 15-year career, never seen that happen before in one day. So what's happening next? What can we expect next? Well, first of all, it's time to take a deep breath and realize mortgage rates are still fantastic. We're still in the low 3s on a 30-year fixed. We're still hanging on to the very low 3s, even the potential for the high 2s on a 15-year fixed. Fantastic territory. Next week, the Federal Reserve is going to meet in a regularly scheduled meeting on Tuesday and Wednesday at 2 p.m. Eastern Time on Wednesday. The Fed will announce changes to the Fed funds rate. Expect at least a half-point cut, maybe even a 3/4 point cut in the Fed funds rate. What impact will that have on mortgage interest rates? I predict 0. And the reason why is that the Fed funds rate is the overnight lending rate. It's a one-day instrument. Mortgages are 30-year terms. They are 30-year instruments. So I have very significant doubts that the Fed funds rate change will impact our mortgage interest rates. More interesting will be the Fed investment into the bond market. The Fed announced some stimulus package yesterday. I expect more of that in the coming weeks, and that will have a potentially greater impact as the Fed becomes a serious purchaser of all of this excess supply. A lot to unpack there. By all means, please reach out. Have your clients reach out if you have any questions. Mark Milam, 404-395-1102. Thanks.